Banks, like any other business, can close or go bankrupt. And while it doesn't happen often, when it does, it can send shockwaves throughout the financial world. Case in point, the banking crisis over the weekend of March 10, when the failure of first Silicon Valley Bank and then Signature Bank led to sharp drops in the stock market and in mortgage rates. So in this video, we are going to discuss what happens to my mortgage if the bank collapses. Now, before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. If you have a mortgage and your bank closes, you might be wondering if that gives you a get-out-of-jail-free card. Unfortunately, no. You still have to make payments on your loan. Even worse news is that making payments while your lender is going bankrupt can get complicated. Fortunately, there are protections in place to safeguard mortgage borrowers in the event of a lender or bank failure. Generally, if your loan has already closed and you've received the funds, it shouldn't be affected if your lender or servicer were to file for bankruptcy or to fold altogether. And while another institution will take over the debt, any repayments you've already made won't get lost or wiped off the books. Since the abrupt collapse of Silicon Valley Bank, questions around the safety and integrity of all things banking have been swarming. One of those questions is, what happens to my mortgage if my bank fails? There's good news here. If the bank that holds your mortgage goes under, the status of your loan won't change because it will be acquired by a new lender, according to reporting from the Wall Street Journal, so there's no cause for stress. That said, you do need to be diligent and take certain steps to protect your finances in the event that your mortgage lender goes belly up. When your mortgage lender goes bankrupt after your loan closes, because of the way your mortgage is handled after closing, if your lender goes bankrupt or out of business, whether it be the company that originated the loan or a third party that later bought it, it should have no impact on you or your loan. The borrower is never informed about the lender's financial problems, explains Christopher Berglund, owner of We Buy Houses Fast, LLC in Austin, Texas. If the bank's charter is in jeopardy, the bank's insurer or regulatory agency will step in to take over. This takeover typically ends with the FDIC inducing another lender to take on that bank's loans. If your mortgage were to be taken over by another bank or lender, the servicing of the loan would become the new owner's responsibility. Generally, the servicer or institutional investor servicing your loan is unlikely to go bankrupt, notes Bruce Alien, an Atlanta-based real estate attorney and realtor. But if they get into trouble, they will sell your loan or servicing rights to someone else, Alien says. If your loan servicer changes, you will receive a notification confirming the change from both the old servicer and the new servicer. This notice will include information on where to send your payment. Your balance will stay the same, and your amortization will remain the same, Berglund says. Your responsibilities will remain unchanged. You'll need to pay your mortgage on time, keep the property insured, and make sure your taxes are paid. When your mortgage lender goes bankrupt before the closing, you're preparing to close on your mortgage, but hear that your lender is in dire financial straits. Should you start sweating? The short answer is no. According to Alien, any funds you have transferred to an escrow agent should be secure if your prospective lender gets into trouble, but you will have to find a new lender to get a loan. Typically, lenders cease to underwrite loans if they approach insolvency. But if your financing has already been approved, getting a new lender might not be that hard, thanks to today's more standardized underwriting guidelines and methods. Back in 2008, a few lenders did file for bankruptcy protection post-loan approval and pre-closing, and the borrowers on these loans had to scramble to move their loan to a new lender, Berglund recalls. Thankfully, because most loans now are typically underwritten by Fannie Mae, Freddie Mac, or FA guidelines, the appraisal you already had done can be shifted over to a different lender for the same loan type. Do you still pay your mortgage lender if they go bankrupt? Yes, even if your lender goes bankrupt, you still have to pay your mortgage. As part of the bankruptcy proceedings, your loan will likely be sold off to another company, and they'll expect you to continue payments. If you do stop paying your mortgage, you could put yourself at risk of foreclosure by whoever winds up owning your loan after the bankruptcy proceedings finish. They might cut you a little slack if a payment is late. Given the delays that can happen during a changeover, grace periods are standard, but don't try to take advantage of the situation by deliberately being tardy. How to deal with your new mortgage lender. While you probably won't get any advance notice that your lender is in trouble, telling you is just bad for business, you should eventually receive mail explaining the changing of hands, says Ethan Taub, CEO of Debtree. It would be good practice to at least have a phone call with your new lender, recommends Taub. This way you can learn more about them and any changes in how they operate regarding receiving payments, making accelerated payments if you choose to do so, and other matters you have questions about. Again, if your mortgage lender fails or files for bankruptcy, nothing should change for you personally. All of your loan terms, your interest rate, monthly payment, and remaining balance will remain the same. But when you chat with the new lender, double-check the procedure for making payments. If you do autopay, you may well have to rejigger a few things, and the address. Check that your account is current as well. Any payments you've made during the handover should be forwarded to the new lender, but you don't want anything getting lost in transit. How to find out who holds your mortgage. If you're unsure of who owns your mortgage, you can look your loan up online via Fannie Mae or Freddie Mac, call your mortgage servicer, or send a written request to your servicer requesting the name of your mortgage owner. Download a sample letter you can customize and send to your servicer. The servicer is required by law to provide you, to the best of its knowledge, the name, address, and telephone number of the party that owns your loan. According to Freedom Law Firm, you'll want to check your mortgage loan for a section that explains what happens in the case of a sale or assignment. This document should state that the terms of the mortgage remain in force regardless of bankruptcy of the lender. Keep up with monthly payments as usual. If your lending institution goes bankrupt, that doesn't mean you get a break from your obligation to your mortgage. You must continue payments as normal. Do not miss a month. Maintain diligent records. If your mortgage provider is in trouble, its customer service wing will probably take a beating, making it difficult to get a hold of someone to walk you through the goings-on. Make sure you have all your ducks in a row by keeping track of all documents your lender is sending you to keep you in the loop. Keep a paper or digital record of your mortgage payment history just in case an issue arises down the road and your bank hasn't been paying off the loan properly on your behalf. Check that your payments are clearing. Check that all your previous payments have cleared. According to Freedom Law Firm, one worst-case scenario is that your new lender doesn't have receipt of your payment history and doesn't believe you made a payment to your old lender, which may have neglected to forward your payment onto the new lender. Make sure this is really happening and isn't a scam. Your mortgage will be bought out by a new lender, but check to be sure that everything adds up. Just because you receive a letter saying your account has been sold doesn't mean it has been. A scammer could be trying to dupe you into sending money to a sham organization. Do your homework and make sure your financial institution has indeed collapsed, and that the new lender is who it says it is. If you're in the process of buying a home, take this step. If you're in the process of purchasing a home, there is an extra step you can take to protect your deposit on the property you are looking to buy. Request that the purchase agreement include a provision for the event the lender goes under or can't provide the loan for reasons beyond your control. This is called a funding contingency and is a perfectly reasonable ask. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.